Investor engagement approaches vary significantly across asset classes because investors possess different ownership rights, influence mechanisms, investment horizons, and relationships with issuers. While the objective of stewardship remains the same, protecting and enhancing long-term value, the methods used to engage differ according to the characteristics of each asset class. In public equities, investors often have direct ownership rights and voting powers, whereas fixed-income investors, private market participants, and infrastructure investors may rely on contractual relationships, governance arrangements, or ongoing dialogue. Effective stewardship, therefore, requires asset class-specific engagement strategies that reflect the nature of the investment, available influence channels, and material ESG risks. In listed equities, engagement is generally the most developed and influential because shareholders possess voting rights and direct ownership interests. Investors can engage with management teams and boards on governance, strategy, executive compensation, climate risk, human capital management, and other material ESG issues. Stewardship tools include direct meetings, shareholder resolutions, proxy voting, collaborative engagement initiatives, and escalation strategies when concerns remain unresolved. Equity investors often maintain ongoing dialogue with companies because ownership rights provide significant opportunities to influence behavior and encourage long-term value creation. Consequently, listed equities are frequently considered the traditional foundation of engagement and stewardship activities. In corporate fixed income, engagement differs because bondholders generally do not possess voting rights comparable to shareholders. Nevertheless, fixed-income investors can still influence issuers through dialogue regarding material ESG risks, credit quality, capital allocation, and long-term financial resilience. Engagement is particularly important during debt issuance, refinancing activities, and ongoing credit monitoring. Investors assess whether environmental, social, or governance risks could affect an issuer's ability to meet future obligations and maintain creditworthiness. Engagement, therefore, focuses on risk mitigation, disclosure quality, and strategic management of ESG issues that could influence repayment capacity and long-term financial stability. Sovereign debt engagement presents unique challenges because investors engage with governments rather than corporations. Areas of focus may include governance quality, corruption controls, human rights, environmental policies, economic management, social development, and institutional effectiveness. Influence is often exercised through dialogue with government representatives, participation in policy discussions, and collaboration with international organizations. Since sovereign issuers operate within political systems, engagement outcomes may develop more slowly than in corporate settings. Investors must therefore consider country-specific circumstances, regulatory frameworks, and broader societal issues when assessing ESG risks and conducting stewardship activities within sovereign bond portfolios. In private equity, private debt, real estate, and infrastructure, investors often possess greater direct influence over assets and management than in public markets. Private equity managers frequently hold board seats and maintain close relationships with portfolio companies, allowing active oversight of governance structures, ESG integration, and strategic decision-making. Private debt investors engage with borrowers throughout the lending relationship to monitor emerging ESG risks. Real estate investors engage with tenants and communities to improve environmental and social outcomes, while infrastructure investors influence operations through governance arrangements and long-term asset management responsibilities. These private market characteristics often create opportunities for deeper and more sustained engagement. For fund investments and multi-layered investment structures, engagement focuses primarily on the managers responsible for underlying assets rather than direct interaction with portfolio companies. Investors assess whether fund managers effectively integrate ESG factors, conduct stewardship activities, exercise voting rights appropriately, and manage engagement programs successfully. This approach seeks to close the agency gap that can arise when investors are separated from underlying holdings. Across all asset classes, successful engagement requires alignment between stewardship objectives, investment strategies, available influence mechanisms, and resource allocation. Although engagement methods differ, the common purpose remains enhancing long-term value, managing ESG risks, and fulfilling fiduciary responsibilities through active and responsible ownership.